So thank you for coming. Walter and I are both trustees of the trust funds. We have a third one. And Dave could not be here, and we are Zooming, and it will be posted on the town website because technically we are a quorum here, although we're not going to be voting on anything or doing anything. We do want to post that. There are about 11 trust funds that we as trustees of the trust funds are managers of, one of which is the Blake Fund, which involves the Firefighters Association. Now, we have done the history of the Blake Fund, and we understand, how the trust has been dissolved, and that it is approximately, and I've got some values there, I'm going to talk about this in a minute. But the way it stands right now, according to the will of Blake, is about 5% of this fund can be used, and you'll have to help me with the wording, for firefighters' own, what would you call it, like education or training. Okay, thank you. And about 95% of the fund can be used for scholarships. Now, having said that, I want you to keep, and I'm not going to do a lot of math, I promise, okay, but you want to keep in mind that you can only spend about 3% of a trust and maintain its value, keep it running, or you can run the thing dry. And as everybody probably saw me in the meeting, back in February, depletion is an extremely steep calculus. And right now we are looking at the Scribner Trust, which is one of the 11, and it is already so depleted that we're probably already into the principal, which is something we can't spend, even though it has a balance of like $90,000. So everybody gets real excited because when you see how much money, like this is, and listen, it's more than is in my bank account, it's a lot of money. But you have to remember, you don't have that much to spend. At most, you can spend about 3% of it and annually and maintain its amount so that it continues to grow, keep up with inflation, doesn't deplete. So if you've got like 72,000, for example, 3% of that, well, 10% would be about 7,000. So half of that would be 3,500, and then that's 5%. So 3% would be like maybe, 2,500, 2,000. So you see that 72,000, you're like, no, you got about 2,000 you can spend to maintain it. And that has been, historically speaking, a real problem in the town of Ashland, is understanding that depletion calculus. And many of our trusts are in not great shape. So let's talk about the Blake Fund. And I want to compare it to the Memorial Park Fund, which is another trust in town. And these are really great comparisons because they're fairly similar in value, pretty close in value, particularly right now. But they're invested very differently, and that's something that Walter's going to talk about. So right now in January 2020, the Blake Fund had $72,000 in it. Now in March, okay, it got bad in March, okay, and it went down to 55,000. It lost 23%, if you want to do the math. How much down was it? It was down 23%. Yikes. About 1/4 of it was gone. Okay. Now, currently, right now, it's about 67,000. I looked at these numbers yesterday. I know the market was really up high today. Even though the market goes up like over 400 points, it's not going to affect this balance as much as you think. Okay, maybe a couple of hundred bucks. So it's now at 67,000, which is better than 55. But it's still down 7% for the year because it's not 72,000 where it was. Okay.
Did we take money out of it?
Now, when was the money taken out?
Money was taken out. It was taken out in the first quarter this year.
Okay, so it was 4,000?
It was 4,000.
Okay, so if we put that 72, then we take it down 4, we'd be 68. So it is not down as much. So that's a good point. That's a good point. But now let's think about it in another way too. If the 4,000 had not been taken out, it would be up a lot more.
Right.
We'd be back up to 71.
But yeah.
We'd be almost where we were.
We'd be almost where we were.
Right.
So that's pretty good.
Yeah.
Okay, so the thing about the Blake Fund though, is that when it has these big skips, you're really.
But that's not really a skip because we took money out of it.
Okay, so the skip is less than that.
It would have been 71, you said.
Okay, but it still went down to 55.
Because we took money out.
No, well, you didn't take 20,000 out. You took 4,000 out.
Well, what?
Yeah, well, it would be down to 59,000.
It would be down to
But that's what you said.
59,000. Okay,
We
okay.
took 4,000 out.
Okay.
So 4,000 out, but it still had a big, and so when you look at the graphics on it, you know, okay,
Yeah, but
you get
if
one
we
of these
had
things.
left it, it would have been the same right now.
Pretty
Only
close.
1% down.
Pretty close, exactly,
Yeah.
right, pretty
Okay,
close.
so that's not bad.
But it took a big,
Funds lost 2% overall.
Yeah, that's not too bad.
now, let's look at the Memorial Park Fund, and to my knowledge, there hasn't been anything taken out of this year. Has Memorial Park had something taken out, Walter?
Year to date, Memorial Park has had no withdrawals.
Okay, now Memorial Park started out at 63, and then when the March thing hit, it went down to 53, and it was down 16%. Now, you're right, Craig, this would not be 23%. It'd probably be something like closer to 20%.
Yeah, no.
Okay.
I knew we took some money out.
But it's down more than this was down, is my point, okay? And currently, you know, it's really almost right back up. Now, you're
It's only
right.
down 1% for the year.
You're right.
Yep.
You're down, you're close, but the thing about it, when you look at the graphics on Memorial Park, is you're looking at something like this. Okay?
Mhm.
It's less. And the way that things are currently invested, you know, when things are up, they're up. And when things are down, they're sub-basement on Blake. Okay? And those of you that have a bit of a history with the Blake Fund, you know, may have remembered seeing some years where there was a concern, you know, oh my gosh, do we have the money? I got signed out somehow. I don't know how, I know, it still says it's recording. When you have a concern about having the money for the scholarships. And that's why Walter and I are here tonight, is we want to try to explain where Blake is, what we're going to do with Blake, so that you don't have concern about, do we have the money for the scholarships? And when should we pull it out? To get a more balanced portfolio so that you have a stable, predictable income. To stop things like this from happening, and maybe something like that. We can't stop the market from contracting. A free market economy cycle, that's a fact. But we can stop that contraction from being so deep that you're left some years wondering, oh, I don't know, can we do this? Where do we get the money for the scholarships? That this will be a stable and reliable income source. Okay.
All right. So the way the fund is currently invested is 95% stocks, straight stocks. And looking at the basket that the advisors at Wells Fargo have invested in, I'm not going to say it's a bad basket. It's actually a really good basket of different companies, different parts of the markets, different weights. It really mimics the overall economy that we see today and the makeup of the market. In fact, personally, I own a lot of them and would recommend them to people who are interested in investing. The remaining 5% is held in money markets. That's cash, that's short term. That works out to about, what they say, $2,300, $2,200 in today's balances. The problem with owning straight stock is like Amanda's saying, when it's up great. But when a company misses its earning reports 2-3 quarters in a row, CEO does something scandalous, product fails horribly, the market can say, we don't want to own this company anymore, and it's gone. It goes from the top and great performance to being, delisted because it can't maintain $1 a share. The bigger problem with owning straight stock is that we as trustees are bound by state law to have an investment policy in place. And that investment policy requires that we are investing as prudent people. And that's part of our duty of loyalty and our duty of obedience that we take as trustees. And that is realistically to stick to investment objectives. We as trustees have adopted a policy that says our overarching objective for all of the trust funds that we have custody of are to protect from principal loss, like Amanda talked about. And loss including including loss of purchasing power, while generating income sufficient to support the programs intended to be financed under the terms of the trust documents. So, the market's up, it's doing great. When it's down, it's really down when it's all straight stock. We as trustees have furthermore in our policy adopted that we will not hold straight stock, straight bonds within trust funds because of the volatility associated with owning those purchases, owning those positions directly without being actively managing it every single day.
Mhm.
That can be done. You can own individual stocks, individual bonds, if you are an active investor.
It's like having all your eggs in one basket if all you own are stocks. And historically speaking, like a bond, you've probably heard of bonds, like when schools have bonds, school bond issues and stuff like that, or you can buy bonds into water companies and electric companies and things. They're a little different than stocks. They don't pay out as much money as a stock. So you're not going to make as much money in a bond, but when stocks go down, bonds go up.
And the thing to keep in mind too with this isn't a retirement fund.
Right.
We don't have 10 years for this to rebound.
Right.
We want to give scholarships out every year. So,
Yeah.
you know, if at any point the stock market hits a crash like in 08,
yeah,
you know, we would be down
We
and we
have
wouldn't be
zero
able to
impact.
give scholarships
Right.
for
Well,
10, 15, which is what happens.
but that's not true. We would always supplement.
Well, yeah,
But
we
we're
don't
trying to get
want
you
to
not
have
to
to
having to do. And also, I've thought
I'm
about
just
this.
saying,
No,
as an
I know
organization,
that.
we'll
Yeah.
supplement.
I know
make
that, but what I'm
choice.
saying though
We've
is
always done that.
we have, and I acknowledge that, and I've
Yeah.
let them know that, or I've let Amanda know that we've always have supplemented,
Yeah.
but we don't want to necessarily have to do that. And if we can maintain our fund, or they can maintain the fund so we don't have to.
Yeah.
What I'm saying though is,
Yeah. No,
you know, stocks are great, but this isn't a retirement fund.
Right,
We'll have 10,
right.
20 years for it to recover.
And this 59,000, now that I think about it, wouldn't be 59,000 because the 4,000, had you left it in, would also have depleted along with everything else. So it probably would have been more like maybe 57.
Yeah.
It would have had a heavy loss. It wouldn't have been maybe 57.5. Okay.
So, yeah, if you wanted to think about it in terms of a retirement account for a moment, the one person I'd recommend having a portfolio like this to is Jarrett, because Jarrett's young
Yeah,
enough
it can
at
be risky.
19, 20 years old. You can be like this today and probably for the next 4 or 5 years being 95% stock. And, you know, by the time you hit 30, you probably want to be thinking about being 20% in fixed income, which is bonds. And as you get closer to retirement age, you're reducing your exposure to the volatility in equities and increasing your exposure to fixed income. So if you want to think about, again, in terms of retirement, we should be treating these trust funds as though they belong to somebody who's 65 and just retired. And they built that principal over a lifetime, and now they want to protect that principal and live off the income that it generates.
And have a steady, predictable income, knowing exactly. And then that goes back also to the 3% rule of when you see 72,000 in the account, you don't have 72,000 to spend. You've got about 2,000 to spend. Because you can't spend too much or you'll deplete it down.
The other striking thing that I found in looking at the fund's performance since it's been with Wells Fargo, which looks like it started with them in 2016. So this 2020 is the first time we've taken any money out, as far as I can tell, $4,000. Part of that will be left it alone. We deposited $48,900 4 years ago, and today, you know, the fund has a balance of $68,242 at the close in the market. Good news is it was up $1,200 today. That was almost 2%. Bad news is it could be down 4% tomorrow. Don't know what the market's going to do. What I was really shocked to find out, and I don't think that anyone in this room knew, is that Wells Fargo was charging the account, this trust fund, $1,000 a year in management fees. That's 1.5% of its value today. And in terms of industry standards, that's 50% higher than the typical account manager should be charging us. So think about that. That's one whole entire scholarship gone, the whole entire year. We don't even get to see that money. It's gone. The advisor took it, and that's one less person we could help out. What we as trustees are in the process of doing are moving the accounts that we have with Wells Fargo to Vanguard Investments. Vanguard offers investment products that are strikingly similar, but for much less money. And the advisory fees we'd be saving on all three of the funds that are with Wells Fargo, about $3,000 a year in management fees and advisory fees. The products themselves actually at Vanguard, we can get into the minutia of it, but I'll bore you the details for now. They perform better than what Wells Fargo has in products. But The bigger thing for this fund is we as trustees recommend moving away from a fund that's 95% invested in stock and holding 5% in cash to having a fund that holds no more than 55% in stocks. And that's distributed over a wide swath of global and domestic markets. Instead of holding direct stocks, it would be equity mutual funds. I'm no more than 35% in fixed income mutual funds, so those are bonds and short and intermediate life cycles. There's more volatility when you go out to holding long-term stocks, and then keeping about 5 to 10% in cash. So that's what you'd rely on in those lean years when the market has a really, really bad year and is down 20%. Well, guess what? You've got 5,000-6,000 sitting in the cash account. That's just, it's not earning great interest, but it's there, it's available. And so when the market jumps and rebounds 30% the next year, hey, we can take a chunk of that out and move it to the cash account.
And you'll always have the money for your scholarships. You'll always have the money for your firefighter training that Blake, wanted in his will to go forward.
So
that would always be available.
Is it going to grow as fast as the way it was previously invested? No. Will it depreciate as fast when the market is down? Also no, because the mutual funds have certain triggers put into them to protect them from sudden losses from the investors. Yes, they will contract when the market contracts, but they will not contract at the same rate as the raw, pure market. There are protections in place.
And you'll have another $1,000 anyway, because the fees is going to go from $1,000 a year to like $80.
So having that larger stock component, again, being over 50%, helps beat inflation every year. So typically every dollar that you have on January 1st of the year is worth 97 cents on January 1st the following year. So if you invest a component of that in stock, that helps your account beat that inflationary erosion. And then having a big chunk in bonds gives you that fixed income. So bonds pay every month, like a CD at a bank. They're kind of like a fancy CD in terms. So you guarantee that income every month. And yeah, bond prices go up and down because they're traded on the open market versus your CD being insured in the bank.
So as far as when you want to use, our goal, like I said, is to make it stable, a predictable income, how much there is. When do you foresee, as an association, needing funds or giving scholarships? Am I going to assume that the scholarship thought's going to be like February, March?
Yeah,
Yes, after the first grades come out.
Yeah, so typically it's January.
So the first semester, when that's
Like
over.
January 15th.
So, they'll submit their grades and then.
Every once in a while we get a little late, which is, happens.
And you pick not Plymouth Regional, but you do the decision making yourself.
We do.
Okay.
And
Which is fine. I mean, I'm just trying to,
there are years that we don't give them at all.
Right.
Because there are requirements that they have to meet.
There just may not be a suitable candidate.
Exactly. And it does vary how much we give, especially depending on whether it is a direct member's child or not.
Sure.
But yeah, we present the award in June. And then the scholarship is actually given and the check is written in around January, February.
Yeah. So as far as like firefighter training goes, because from the way I can,
typically those funds, they've never been touched since
So
I've
a
been
lot of
president.
times we used to give it to the explorers out of that.
Yeah.
it'd be very little. It'd be 5%. Let's just call this rounded off to 70. It'd be 5% of 70, which is 3,500. But then I said, you don't want to spend more than 3% of that 3,500. So now you're down to something like $90.
Yeah,
That's not much.
we've never pulled from it since I've been president, which has been 2 years.
It's been a long time.
Okay. But
Yeah,
that could
it's
get
not enough.
exactly. It's not enough, but that could get to a point. What would be enough? What would be the kind of balance you would need?
Chatted about, we've been working on a special project about building a training prop. And I don't know if it's something we can do, but we've chatted about just possibly pulling the funds out of it in one fell swoop. for the training and then leaving it alone and never pulling again for it.
Well, I don't know that you can do that because you can't.
Yeah, that's why I just said,
Regulations
that I'm not
about
sure if we
But
can.
how much would you need for that training? What are you
I'm
talking about?
not, we haven't,
$5,000, $10,000?
I think, I mean, I don't think it was discussed more than a couple thousand. I'm not completely sure. I have to pull the notes back.
Okay.
Um,
Because if that's something that we know about, and again, like 5% of this is set aside for firefighter training, then we could, you know, Walter and Dave and I could work on trying to get a corpus. It could take, it won't be tomorrow, but you know, it could take some time, but we could invest and set aside money with that goal.
yeah.
Was that a fixed amount of money that was earmarked in the will?
Well,
It was $5,000.
yeah. Technically it was $5,000 because it was,
I think you're wrong on the percentage.
No, not, on the percentage of the amount of money, because I have the
Because
materials.
the original will set aside $5,000 for training.
Yeah,
And
$5,000.
$45,000 for scholarship.
Right,
So when you take that to 100%, it's 10%,
50,000, 10%.
and 90%.
Oh, that's
Five.
right. Okay, I'm sorry. I was thinking the 5 got in my way, the 5,000.
So-
That's correct, yeah.
Where I'm going with that
10%.
is, should we actually take this, it's technically a commingled.
yeah, it's a commingled
Which
fund.
was a terrible thing.
We can, if, with, and this, I think this is a discussion for
The
the association to have. If the association wants to have this discussion, I'm just gonna put it out there, and I'm speaking as a town trustee here. The association could look at what's available in the account and say, no, we wanna leave it commingled, or no, we want to split that into 2 sub-trusts.
Is there enough to split? I mean, 10% of 67,000 is 6,700. Is that enough to split into a second fund?
Yeah.
Yes,
That
We'll
meets
put
the
that on.
minimum requirements.
that meets the minimum requirements.
And it certainly makes, I'm not telling you what to do, but it would certainly make the trustees' position easier. Because then
I
we're
mean, I
not
think it
having
would
to
be
do
a
the
lot
math.
easier for us to see it as well.
Yeah.
Absolutely.
Yeah,
It would be a lot easier to track.
And then it'd be a
It's
lot
a
of-
nightmare for me to try to figure out what percentage is available to the chief, what percentage is available to scholarships. And every time somebody changes or takes some, you
yeah,
have to credit it to that part.
yeah.
And that was the only thing that was accomplished with that year and a half in court, and all the money we spent.
Okay, I will, that's on the docket for us to discuss then.
Yeah, that would make everything a lot. And then, like I said, we could invest that in a way that would be toward your goal. If you want a fire prop, you know, we have something going towards that, we would know.
Because there's a lot of stipulations too on the educational part.
Yes,
There isn't on the chief's part.
yeah. Does anyone have any other questions? Well, do feel free always to ask Walter or me or, you know, Dave Toth, any questions you ever have. I mean, we manage the Blake Fund, you know, but it's your fund, you know, but you're constrained by the purposes from the will, you know, we can't all go to the Bahamas on it, which would be great. But please do always ask us and feel free, you know, to ask or have us come to one of your meetings or something again if you have any questions about what you want to do or the purposes or anything, because we'd be more than happy to talk to you about it.
Can we get like a monthly synopsis of what's going on?
A statement from Vanguard?
Oh, absolutely.
Sure.
Yeah, no, as,
Well, we
as,
used to get them from Tom for
Yeah.
Fargo.
Yeah.
So what
haven't seen any since February.
what I can do is when we move the funds to Vanguard, which will be in the next couple of weeks, I've got the first, we're doing Scribner and we're gonna do Blake and then Memorial Park. When I move them to Vanguard, we, as trustees by default, will get the statements, but I can also order a separate statement sent directly to you.
If it's available.
Well,
via
it's a
email, you
Vanguard
just-
fund.
Mhm.
You can just go online probably and see what
Yeah.
it's doing.
Mhm.
Well, with Wells Fargo, you can't.
Oh, yeah.
You have to do every stock individually.
Yeah, it's a pain in the butt, and everything I wanna do, I have to call a gentleman in Manchester and get asked 20 questions. It's like, I know what I'm doing, just push the button.
Yeah, but of course, absolutely, we can, you know, once they're moved, I think it'll be the easiest, as Walter said.
And anytime you ask, I know how to print the monthly statements from Wells Fargo.
Yeah,
So
Okay.
I have, we have
I
access
could
to
do that
them.
too, I could print monthly statements. Do you have an email? Because I could
Yeah.
probably screenshot and send them to
We
you.
email back and forth the numbers.
Yeah,
Oh,
should be able to
oh, Wendell,
save,
you're Wendell though. I'm
Sure.
sorry,
Yeah.
okay, yes.
Should be able to save them as a PDF and send them right as an attachment.
Oh, okay, yeah, so I'd be glad to do that, sure. I can go home and do that tonight on the, August statement.
That's fine.
Actually, it should go far, if we're savvy enough, we might be able to give you everything from February on in monthly statements.
I'll let Walter
It'll be
be
a large
savvy enough to do
email.
that.
Okay, that's
I'm
fine.
gonna step back on that,
Yeah,
and
I
let Walter
think
do
just the
that.
current one.
Just the current one? Okay.
Oh, okay.
Oh, well, sounds like it's back in Amanda's court.
Okay, okay, we'll see.
Well, the
while I
one,
do
the
that.
one Tom used to do is 2 pages.
Yeah. Yeah, I think he probably gave you a high-level summary, probably the first 2 pages of it.
Yeah.
Versus line-by-line activity.
Okay, I'll see what I can come up with, and I'll send you something, I can't guarantee what it'll be.
And once the funds are with Vanguard, I'm not gonna liquidate all the stock on the same day. That's a pretty silly thing to do. Because some things we'd probably take a bath on, as association members, but speaking as a trustee, you know, the idea is to protect as much of your principal as possible. So watching the market, and there's some things that are gonna be obvious, you know, if it's at the top of its range for the last year, it's a candidate for liquidation.
Mhm.
If it's at the bottom, might try to hold it on a little bit.